because if you recall, I said some very interesting things are happening structurally in that market. And if you didn't get a chance to watch that video, I really encourage you to have a look at last week's portion. Just fast forward to where I was talking about the S&P 500. I really think there's some very interesting things in terms of the price action that's unfolding. So when we were chatting last week, here's what I said. And I kind of pointed out that we were in here, we're about to at that stage, I said, if you look at what's happening in the market, and I pointed out that every time, this trend line was created, we had a couple of bars breaking beneath the moving average, one bar here, a couple of bars here, but at all the times the bulls would come back and buy, and we just carried on with this very strong bull trend. But then we'd had 4 successive selling days, and we were coming right down to that trend line. And I pointed out the reason I'd put up this chart, because price action is repetitive. It's fact, whatever we see on any chart will happen on the time frames that we're trading or in the currency pair that you're trading. So it's the same kind of things that repeat themselves. But so when I saw this, I really thought there's some good lessons here. So here am I speaking. I'm sure you could hear me, but I didn't have my mic on. My apologies. So one of the strategies that we trade is the major trend reversal. Remember, I said this for any price action trader, this has to be your bread and butter, because if you can get in early to a trend reversal, chances are you can make a huge return to your risk, but you have to manage it because most reversals fail. So I'm not repeating that. But here's what's interesting. So keep this in mind. I'm just going to zoom in a little bit more. So we now have very strong trend line, prolonged trend line, break beneath the trend line. Okay, and we pointed out that if you were a bull, you're going to say, okay, take some profits here. So there's profit taking place. You're going to wait, if you're a bull, to see if you get a double bottom here. And if you get a double bottom, then you want to look for a high low and expect the trend to resume. And if you are a bear, of course, you want to get there and you want to see if you can break beneath that and then look for a lower high. But the key ingredients of a trend line so far of a major trend reversal strategy so far have been met. Strong trend line, very easy to determine, break beneath the trend line. We got to the trend line, we had a bounce off the trend line. Okay, so at that stage, if you're a bull, at that stage, legitimately, you could have put your entry above here because you have simply said, well, okay, this is bounces off the trend line carrying on. So just like we put an order above that and get triggered in, or an order above that and get triggered in, or an order above that and get triggered in, you could have put an order above that. And as it turned out, you would not have been triggered in. If you had placed an order above that, and if you had been triggered in, and then the market reverses, your stop would have been, where would your stop have been? We've spoken about this before. Stop would have been below here, or a measured move beneath this. So you'd have been able to get out with a minimal loss. But in any case, you would have been triggered. The fact that bulls were not triggered off a bounce of a strong trend line has got to be telling us and giving us a lot of information. So you are right here, and all of this would not have unfolded, and you'd have seen this inside candle. So let's assume you are a bull. You've seen this inside candle. Say, okay, inside candle, right off my trend line, breakout mode. And if you don't get triggered, if you're a bull, you got to be saying, but hang on a second. Why are the bulls not strong enough to trigger a buyer when we've been bouncing all along? Okay. And then you got to be saying to yourself, there's a lot more information being presented to me here. Let me not just jump into trades. Let me now wait. If you're a bear and you'd seen that, okay, there would not have been any reason for bears to jump in here. Okay, if you're jumping in here, you're taking a counter trade you're scalping. You just gotta get off when it hits the trend line. So let me correct myself. There would not have been a reason for any bear to jump into this trade using the strategies that I'm talking about, that we've been talking about for 9 months now. Okay, we're not scalping. We're waiting for setups where we patiently wait, sets up for us, we jump in, and market moves in our direction. 60% of the time, if it's a trend trade, we make our money. But if you're scalping, there's ways to jump in, just get in there and get off the trend line. But we're not scalping. So there is ways to get in, but that's not how we're trading. So you'd have said to yourself as a bear, okay, fantastic. The bulls had a perfect setup, did not get triggered in. So I gotta jump into the market. So now that looks like a first leg pullback. That's a first leg pullback. Where is the second leg likely to be? So there is the first leg pullback, and there is the second leg. So you can easily put your order beneath that. And where does your stop go? Stop goes that's your technical level, or spoke about this a couple of weeks ago, or a measured move above the small trading range, which is about the same in any case. Okay, so that's where your stop would go. And what are you hoping for? There is the optimal profit. You can take just take your full profits there. That's leg 1, leg 2. That is also the height of the measured move. If you're just looking at the breakout candles, the bear candles, that would be the measured move. So that's a perfect place to take your profit. Alternatively, wait to see, if you're going to sit in and manage a trade, wait to see if we get to there. Managing trading off a daily chart, of course, is different because you got to wait for the closes. So, if you didn't have a take profit there, you'd come back and say, oh, look at what happened, big tail. Okay, let me close my trade. Okay, so that's how you'd have traded this. But in terms of the major trend reversal, besides having taken trades there, break beneath the trend line, double bottom, what do we expect next? We now are expecting the trend to resume. Okay, why would the trend resume? Well, the bulls are saying, well, this is just, thank you very much. This is just a double bottom. So strong bulls are going to jump into the market, and they'll either initiate trades here or wait for a higher low, stop down there, or some maybe have stop all the way down there. They expect the trend line to break at some point. I mean, you got to expect it. So depending whether if you're an institution that has the capacity to hold stops down here, you can do that. If not, well, you observe and say, okay, this might resume, because in a major trend reversal pattern, we expect there to be a resumption. Okay, the resumption could be also 2 legs, like we had a break, which is leg 1, pullback, leg 2. Resumption could be leg 1, pullback, leg 2, which means if you didn't take any trade here, you wait for the pullback and the second leg. And that second leg, may test that, may go a little bit higher or maybe lower. So if you're a bull looking to trade, you'd wait for the way that we trade. Let's wait for the resumption, wait for the high low, you can trade that. But the more that we're talking about is if the bears are strong, if what we're seeing here is a significant structural breakdown of this prolonged bull trend, then at some point, even after resumption, there will be a double top or there will be a lower high. Okay, so when we get the double top, at that point, we are in a trading range because we have a double top with a double bottom. If it's in a market is in a trading range is a breakout mode. But because of the pattern that is unfolding before us, if you are a bear on this time frame or any time frame, if it sets up like this, after the double top, then you look for a lower high. Or if we don't get a perfect double top, we have an attempt to break out above that previous high, you don't jump into a trade. Most breakouts fail. You got to wait and see if we then get another lower high forming at a point in time. So I think this is if you trade the daily chart, opportunities for you. If not, there's a lot of lessons here just to learn from. So if you trade in it, trade. If not, just pop it up, come look at it every day, and just see how the major trend reversal alert sets up. Because if we do get a double top and a lower high, remember the first thing is from that double top low high, you are trading into a trading range. So you sell high, your goal is to get to the bottom here. But because you've seen the major trend reversal alert forming in front of you, if you trade in it, all you want to do is take off a little bit of your profits, because you're anticipating that we might get acceleration beneath that. We might get the bear trend, which might come in the form of a couple of strong candles all the way down here. And to be beautiful if you hold your trade up here. If you take your profits at the bottom of the trading range, that is still fantastic. You're still in a trading range. Go down our trades the trading range and see what happens. So I'm excited about it. There's quite a few things that's happening. I want to just look at the euro and gold. I want to drill down again onto the 5-minute chart of the S&P, because there's something else I want to show you. Let me just have a quick look. Okay. All right, guys. So keep that in mind. We will come back to it. Let's have a look at the euro. It's quite. I'm hoping. This is me hoping. In our presentations, that if you've kind of followed this show in the past, let's say the past 4 or 5 weeks, we've been talking over and over about what we are seeing on these charts, and you should be getting a sense that there is a high level. Whenever I say high level, whenever I say something is certain, always think 60% chance, right? There's no 100%, but there's a high level of probability of when you read the charts using price action. You start to see things beginning to form in a more sensible way, which, excuse me, guys, allows you to trade and take trades on this time frame or any time frame that is set up. So, I mean, we spoke about those levels at great length. Go back a couple of videos and you pick it up. And, we also spoke about what's taking place now here. So, trading range, level of resistance, level of support. Everyone should be watching that level, 1.166 kind of level. That's a magnet. The market may want to get to there and test it. Are the bears going to be strong enough? Are they strong enough to close at some point today, Thursday, Friday, beneath here, put a follow through, and then we're saying, oh, okay, maybe we're breaking beneath this, and look at the measured move. I mean, so if the market was to break beneath here, let's just use this measured move so we don't clutter our charts. Okay, if we got to here and we broke beneath that, then the measured move is that high to that low. There is the same equidistance. That's where the market would like to get to. That's your 1.14 kind of level. Can the market get there? Well, we know it can. Why? Because we know that when the market breaks out and there's a clear structure, the goal is to get to a measured move off that price structure that's been broken out of. If bulls are strong enough, well, we get a double bottom. And if we get a double bottom, so that bottom and that bottom, double bottom, then all you're waiting for is a higher low, and you're trading at the bottom of a trading range. Your goal is to see if you can get to the top and take your profit in the upper third of the trading range and, you carry on like that. But it looks very clean if you consistently following through and looking at it. Now, if you drill down to what is happening on a day-by-day basis, a little bit more information is presented to you, which helps you trade. So, when we bounced off here, double top, and we had followed through by the bears, fantastic, bears they followed through. Now, if you're looking for ways to trade there, you got to look for a lower high, a distinct lower high. But we entered into a trading range. This tails here is this is a trading range price action. Now, when you have trading range price action, you got to be looking at selling off the top, aiming for the bottom, buying from the bottom, going to the top. But it's too tight for you to be trading here in terms of where you put your stop and how much returns you get. So you wait. Let me just, I have to keep reminding myself to put things on the chat that are in my head. So we're looking at the same thing. And I'm hoping that you also start to get a sense that it's really just a matter of charts that you look at. And, when I start going into price action trading, the advice I was given is, George, you have to look at hundreds and hundreds of charts. And I was like, I get it. You don't actually get it until you look at hundreds and hundreds of charts, print them out, mark things down, find those measured moves, draw, mark them on your screens, just do it over and over again. Eventually, it will just, okay, now that starts to make sense. Okay, so we have that trading range. Now, when you see that trading range, what comes to mind? Okay, market will break out of a trading range, but most breakouts fail. So the only way to protect yourself and make sure that the trades that you are taking are in your favor in terms of the trader's equation is you have to wait for a breakout, see the breakout candle. Okay, so every single bar, every single candle makes sense, gives you information. So there we had our trading range from that high to that low. Look at that bear candle. Without thinking about the trading range, you might say, oh my goodness, look at the bears, so strong. But if the bears are strong, why didn't they give me a very strong close beneath that trading range? Automatically, I'm saying to myself, there's a problem. Okay, so if you start to ask yourself questions, if you start to engage the market, and you see when I show you, I mean, there really was a day 60-40 in our favor in terms of the trend strategy that we trade. But if you had been continually asking yourself questions, you would have seen it unfolding, and then you know your risk, you know where to put your stops, you start to execute your trades. And sometimes the market just rewards you so beautifully with one of those trend days that if you're patient enough and if you are mentally active enough to be asking questions of the market and answering it, you're talking to yourself, right? You say, but hang on a second. The bears are strong. Why didn't they give me a strong close beneath here, closing beneath the low? So there's a problem. Let me wait to see what happens with the next candle. Next candle comes. Oh, okay, this is a fantastic. It's a strong close beneath that low. So they were not strong enough there, but they had a follow through. So if these bears are strong, after giving me that follow through candle, although they failed there, I will see another strong candle. Then I want to see a pullback, then I want to trade. But what happens the very next candle, very next bar, the very next day, the very next whatever hour or 4 hours, the bears fail. They failed to give me a follow through. And I'm like, okay, now they really is a problem. We failed to have follow through breakout beneath the candle, beneath this trading range. Now we have a dodgy candle. The bears are not strong enough. What is the market telling me? Number one, the bears are weak. Number two, am I going to get a higher low here? Why are the bears not strong enough? So I'm not going to jump into any trades. So even if this had been a decent enough high test candle, bit of closing, don't jump into the trade. The information is telling you that there's something wrong here. And if there's something wrong, just wait. Because when you don't have all these questions, when things are right, when you jump in, even with a 60% possibility of probability of success, you will make good monies. Okay, so as a price action trader, be very willing to just sit and observe. That's why when you're trading off the 5-minute time frame, if you have a few defined strategies, like we have defined strategies, everything kind of slows down beautifully. And you can work, you can wait, you can follow through, you can understand it, then you can execute the trades. So as it is now, on this, on the daily time frame, there's nothing for you to do but wait. What are you waiting for? Well, you got to wait and see, okay, let me see if I'm going to get a double bottom here, because now, I'm in the lower third of this trading range. Okay, if I'm in the lower third of this trading range and I don't have bearish strength that's been shown, I don't want to be selling. I want to be waiting to see if there's an opportunity to buy. Okay, and I'm not going to buy up here if there is a magnet which can pull the market down, which is this level of support. So let's just wait patiently and see what we get. The trades will come, and when they come, we execute the trades. Okay, so gold. Let's have a quick look at gold. Again, we spoke at length. Now, what's interesting, and I'm really excited when I see these things with price action trading. I really am excited because, as a price action trader, I've stripped away, save for my exponential moving averages. I've stripped away all other indicators. I'm putting things on the charts and waiting to see if price gets there and getting my information from that. So when I saw this, and we speak about strong bear candle, fantastic, follow through, dodgy, but let's see now. So from there to there, that's a bear breakout. Now let's see at that point when that formed, if that becomes a leg 2. So leg 1, there is a pullback, end of the pullback is right there. Let's see if that becomes a leg 2. So if you'd seen that, you've seen that strong break, there is a pullback, there's an inside. So that's a dodgy candle, but there is an inside candle. Okay, so you're thinking of the patterns that are forming for you. Remember, whenever you see an inside candle, you've got to think breakout mode. When you see an inside candle, inside, so a candle inside another candle, another inside candle, fantastic, even strong breakout mode. The market will break out of that. But if the market breaks out of that, most breakouts fail. So expect a failure, resumption, and then look for a trade opportunity. So even though this is a dodgy candle, that inside candle says to me, possible breakout mode. I'm still thinking bearish. Let's see what happens. So there's an attempt by the bulls, fails, beautiful high test candle, nice reversal. Okay, I can put my order beneath that. Stop has to go, stop must go. What am I trying to get? I'm trying to get to a measured move. There's a breakout, that height. Okay, you see, so we're breaking out. Let me just move it. Okay, so the market breaking out beneath here, and the end of the breakout is the end of the bear bodies. Let's put that there, so you can do that. Or you can go to the beginning of the breakout. You can go to the end of the breakout. What's the difference? Remember, I always say when you put your, well, I hope I always say that. I think I say it a lot, but I don't know if it's always. If you're looking at taking profits, the measured moves, leg 1, leg 2, shows you the optimal profit, or the earliest profits, right? And then there's obviously the maximum profit, the furthest away profit. So if you measure your breakout, the highest distance, highest height, I hope that's good English, highest height, from there to there, obviously you get a much larger measured move. So if market gets to there, that's more profits. But if you're only looking at the bodies and the breakout, so breaking out beneath that, and the bodies of the breakout, get into there, that's where you take earliest profits. Okay, so it just depends where you want to take your profits. So if you put your entry above that, undoubtedly, depending how far you go, you'd have been triggered into the market and your stop is there. What happens when the market pulls back? You wait to see what happens thereafter. So now, got triggered in, then I have an outside candle. What is an outside candle? We spoke about it recently. It's another trading range. If it's another trading range, I'm saying to myself, okay, I have a problem here. I've entered into a trade, my stop is here. I was hoping the bears would accelerate down so I can just bank my profit quickly after 2 or 3 days or 15 minutes, but that's failed. Now, the bulls reverse and I have an outside candle. So as a bear, I have a problem at this particular stage, but I'm not getting out because this is a trading range. If it's a trading range, what does it mean? It means bears who had not jumped in are saying, hang on, now this is a good price, fantastic price to go and sell. Okay, because you talk of a trade range. If we sell here and we're hoping to get down there, so don't jump out of a trade when you see that bull candle. Just wait to see what happens in the next candle. If the bulls are strong, you're going to try and break out, and most breakouts fail, it might come back. But you've also got to stop in the market, and you've managed your risk. So there should not be any reason to panic. Okay, and also you should be probably getting the sense that don't just put random stops. Okay, don't take a trade and say, I'm going to put a stop here because, it's the safest, or it's not the safest. And I can have a lot more loss, but I'm protecting. You're not. Put the stop in the correct place, risk, trade size it correctly so that if you're risking 1%, you're still risking 1% because your stop is up here. Then it allows you just to relax and wait and see what happens. Okay, in any case, inside candle, if you are not inside in the trade, if you didn't take that trade, okay, and you see that, then you can jump into the trade. If you'd taken that trade and if you'd put a stop in the incorrect place and you got stopped out, when you see that, you have to jump into the trade and put the stop at the correct place and look to take your profits out. And that's all that's in that is profit taken out of that measured move, that leg 1, leg 2. So all of that is profit taken. Okay, now we've got to wait and see what happens because this particular move has come to an end. So wait and see what forms. Always want to see what happens, moving average, etc. Okay, so I hope that's kind of painting a picture. I want to show, there's just a lot of very good movements that took place. S&P 500. Okay, so this was, let's say you came in, there's a few more this side, previous Friday, and then the Tuesday. So if we have time, I'll open that up, but I just want to focus on what you got. I want to show you macro view first, and then we'll kind of open it up and look at a few things. So here's the point. If you come into the market on the Asian session, and if you'd kind of borne in mind everything that we'd spoken about, you'd have been able to jump into the bear trend. Okay, and we'll look at it. If you'd come into the market somewhere around here, into the London European session, and bearing in mind everything that we've spoken about, just by looking at the charts, you'd have been able to jump into the market, okay, on the bear trend. I shouldn't have that popping up there. Sorry, guys. So the other thing to bear in mind, let me just make this note. If you ever put the S&P 500 to trade, remember, we don't, in terms of the strategies that we trade in, we always look at our news calendar, Forex Factory, FX Street, whatever you use. Whenever there is red news announcements that affect the currency pairs we are trading, we want to stay out of the market. Okay, anything affecting the US dollar, huge announcements, S&P 500, the chances are there will be some movement. You want to stay out of that. Now, another key thing, when the New York Stock Exchange opens, there's usually huge price action. I treat it like news as well. Okay, so I prefer to stay out, just give the market 30 minutes to settle down, because from the guys who are trading that side, just trading on their daily charts, they've got gaps up and gap downs, whereas using the Forex continuous markets, 24/7 markets, we don't have that. So I treat that as red news whenever the 3:30 my time, which is 1:30 GMT in the afternoon, that's kind of when those 30 minutes around there, I'm out of the market. So I treat that as red news when the market opens. Okay, so whichever way, whenever you would have come into the market, you ought to have seen a bear trend. If in any situation you jumped in, probably here, if we jumped in and deciphered the reversal, one of our reversal pairs, jumped in and bought above that, measured move gets you out before the news, or even instead of the news, you're not stopped out, but you can get out and you can quickly see that you're in a bear trend. So at a macro level, I want to dig in, but at a macro level, if you were to go back and look at your charts and say, what happened on this particular day? So you also would have been able to buy the close towards the end of the day, but we'll talk about that. I need you just here's an invitation. Just have a look and see the exactness of measured moves. Okay. Why is it important? Because this is a powerful tool that you have when you're trading. Before you see anything else to your right, when you see you got a low, you got a high, and the market is coming down, before you see anything else that's unfolding, you ought to be able to get your measured move tool. Okay, that's the Fibonacci retracement, and we've shown you how to set that up, and say to yourself, if the market breaks beneath this structure here, this structure that we have, high, low, the market may likely get there. That's all you got to do, and put it up and plonk it in. So I take off, just use my eyes, but you can mark it. So let's say you were there. And you see the market starting to come down before all of this happens. Okay, you're saying if we break beneath here, the market can go there. What does that do? It does one thing. It does which really shifts your psychology. It removes FOMO, the fear of missing out from you. It removes panic. It removes worry. Because you say to yourself, if I don't see a way to get into the market, to get to this low, and if I'm going to hold my trade and see if I can break beneath, if I don't see a way to get there, I'm going to wait. There will be another setup. That's it. And I mean, you know the story. If you make 6% a month, you double your money every year. That's 6% a month. So, we're not trying to make 6% a day. We just say when the market sets up for us, if I can get 1% out of the market on that one day, and if that happens 6 times in a month, trading peacefully, I'm a happy trader. I'm a consistently profitable and happy trader. So there should never be any need to rush. Sometimes the market just doesn't give you the strategies. Sometimes it's just a trading range day, and if you don't know how to trade with limit orders and failed breakouts, it may not take a trade. That's perfectly fine. So maybe it won't happen on euro, maybe it happen on gold. You got 2-3 charts you're looking at, there's opportunity. If there isn't that day, just pack the bags and go. Okay, so measured move, guys, write that down, make a note. That's a tool that you've got to use because it tells you how far the market may go. So you would have seen that, and we'll come back and look at potential where you could have taken trades. I just want to show you the absolute power, if you like, of a measured move. Now, assume you come into the market somewhere here and you say, man, this first part of the Asian session, I wasn't here. This is pretty strong. What can the market do? And the market is going sideways. And you haven't seen all of this stuff here. I mean, immediately you got to be saying, I wonder if this measured move that has been reached here and the market has gone below it. Market didn't turn, because now I'm here, I'm looking at this. Market didn't turn, and if you turn, I would have looked at measured moves the other side, but it didn't. Now, I wonder if all of this is not seen by the market as just one big leg with two parts to it. That first part, bit of sideways price action and breaking beneath the low of the previous day and ongoing. So maybe the market is saying, that's a potential first leg. And all of this could just be a pullback, and the market may want to get to that low. Doesn't mean it's going to get there, but you're seeing all of this, and the goal is to avoid jumping in and just saying, well, I see a couple of bull bars, let me jump in. Oh, I see a bear bar, let me jump in. And you end up 2-3 trades down the line, your psychology is completely messed up, and you're no longer making logical decisions. So you're seeing that and say, well, potentially the market may get there. It may not get there, but if it gets there, isn't that fantastic? Other thing that you could do, which if you're quick enough, you could go up to a higher time frame and look, that could just be a couple of candles, strong bear candles on the hourly. Okay, there's a breakout happening on the hourly, and then come back here. It's not necessary to do so, but if that helps you in the early days to get a sense and feel of the market, that would be fantastic to do that. Okay, so then in here, while you're looking in there, you can't ignore that. Okay, but then you say, okay, George, what of a major trend reversal? Well, you're coming into the market around there, or you want trying to find ways to get in. You say, okay, there's a let's make it a little bit thicker. Just so that we can see it. I'll just change the color as well. Okay. So you say, okay, hang on, there is a trend line, and we know if we get a trend line, if we have a break above the trend line, we are happy because we are now starting getting the formation, the ingredients of a major trend reversal. If it's a major trend reversal, market may go all the way up and I want to get in. But what's the rule of major trend reversal? If I'm trading with the trend, if everything looks like it's setting up beautifully, in my mind, I'm saying this is good. There's a higher level of probability the market's going to keep going down, but that equals to 60-40. So 60% chance that the market will go my way, which is beautiful because you can make money, but there's always a 40% chance, that the market may turn, right? I remember, in my early days when I was learning price action, I thought, 60-40 is good, and I can just trade. And one guy said to me, listen, if I say to you, there's an armed robber there, criminal, who's trying to shoot at you. He is 20 meters away. He's only got a 40% chance of hitting you. Are you going to stand still and say, 40% he can't hit me? Well, of course not. I mean, 40% is very dangerous, very high, which means we are always alert to what's happening in the market. But if you're working with the trend and you've assessed it 60%, major trend reversal, we work on 40%. Why do we work on 40%? Because we are taking a trade within a trading range. Okay, so we'll be taking a trade down here in the hope that this is a major trend reversal, that it will accelerate up. Then I can make a lot more reward than if I waited to take it up a little bit further. So major trend reversal, break, fantastic, good. If I see that, what else do I expect? I expect that the market will test down here. And if it tests down here, then what am I looking for? I then look for a higher low to trade. We don't get a higher low to trade in here. Okay, in fact, get a double top, then another trading range forming. So if it's another trading range forming, and you have a double top, you have other macro double tops here, you should be happy because it's a trading range in a bear trend. And what do we do with trading ranges? We sell at the top and we buy at the bottom. So you can still sell here because you've seen all of this, and your goal can still be at the bottom here. Okay, and then you wait to see what happens. So we'll dig in a little bit more into detail. Let me not get caught up. So look at this. Again, trading range, okay, high, low, look at those two candles, or if you're drawing it down here, yeah, it's going to be super thick. Okay. Not high, that low, market may get down here. Okay. Another trading range, high, low, market may get down here. Another trading range, high, low, market may get down here. Another trading range, high, low, market may get down here. Another, this is a breakout, measured move. So all of these measured moves and the market, first attempt to break the moving average, the 10 moving average and the 20 as well, and the market stayed beneath us. That's a strong breakout. So you just got to keep on selling in this market. Jump into here. So, the market resumes bear price action. Okay, double top. There's the open of the US market, and we've got a trading range going sideways. High, the low, the market breaks beneath that. Market can get down to here, and then you get this strong bear breakout, final flag, final pullback, another breakout. All confirmation, but you are looking for your measured moves. So if you're not in the market, you're looking for measured moves. Then you say, once a breakout finishes and I get the pullback, then you look for an entry at the pullback, which enables me to go for the measured move. So let's just kind of have a look a little bit more. Okay, so measured moves was a key thing to show you first. Now let's assume you were in the market. Let's assume you came into the market. Asian session, you have a look and you say, okay, fantastic, double bottom with the low of the US session, good breakout by the bulls, breaking above the moving average, but we don't quite break above that. You can see that tail there. So we are in a trading range. Okay. We are in a trading range. If you're in a trading range, the rule is pretty simple. You want to buy low, you want to sell high, and you want to get out at the previous low or previous high. Okay. So as beautiful as that is, okay, we broke above the moving average, has followed through, broke above the 20, good, but why are we not breaking above that? The bears are strong, should be breaking above that. So when you see this pullback to the moving average, you can't be trading that because you're at the top of a trading range. So you need to wait. Okay, so the market went up, created a double top, we pulled back, tried to go up again, failed, tried to go up again. Here's a third attempt. So there's a bit of a three push wedge pattern. If the bulls are strong, they'll give me a breakout, good follow through. Now let's see how strong the bulls are. If the bulls are strong, so when we say bar by bar, every candle counts. That price action there is a trading range. Okay. So if the market breaks above that, how far is it likely to go? It's likely to go to the measured move. So you see that, okay, we break out above that, fantastic, get a pullback. You're not going to take that trade because you're already at the measured move. You can't ignore measured moves. Okay, they're giving you information. Take the trade, don't take the trade, because there are hidden levels of resistance and support, which means you can't see them, but they are there. So you can't trade into them. You just got to wait and see what happens. So we have that attempt, another resumption. There's another attempt, but right at the measured move. So we have 3 pushes, 1, 2, 3. That's a wedge. Let me take this off. Wedge 3 push patterns can never be ignored, guys. Okay, the market has tried 3 times to do something at that level of resistance. We tried 3 times, okay, and we failed. And now we have a failed breakout above the double top with 3 pushes, so I'm looking to go short, but I don't go short at the wedge. The wedge it's like a double top. It's like a double bottom. Once you see it, happy days, but I need to see the market breaking out of that, pull back, and then I can jump into the trade. Okay, so there's my low. There's a breakout beneath the wedge. Good news. Okay, bear inside candle, strong bear breakout, follow through. I just got to find ways to get into this trade. Okay, there's a pullback, bouncing off the 10 moving average. Bear candle, you can put your entry beneath that. Stop above the wedge top. Your first goal, if you're not going to be sitting there to watch and manage your trade, just above the bottom of the trading range. Okay, so that's all profit taken. And if you're going to be watching the trade, if you are in the market to watch the trade, okay, you are doing nothing to your stop at this present moment, because we're only going to bring our stop down, if you get a breakout and a pullback, if you are sitting to watch the trade and manage it. If you see a change in price action, you can take corrective action. If you just wait and take your profits there, you can move your stop to break even, because that's where you want to take a profit. If there's a bounce, you're not going to sit around and watch and see if there's further price action. But if you're looking to see what's going to happen on the day, is the day going to bounce off here? Because the opposite could be true. The bulls could come into the market, bounce off here, higher low, and aim to go there. Okay, in this case, they didn't. We closed beneath the low of the day. They tested that low. There is a decent enough reversal pattern. Don't take that particular reversal pattern simply because we didn't get a strong breakout. If we had a strong breakout, if we'd had this kind of price action or this kind of price action, okay, 1, 2 candles and a pullback to test the breakout point, take the trade. Put your stop here. You can tighten your stop, take that trade. Okay. In any case, remember you still have, where was our measured move? We said if we break beneath that, measured move is down here. So now you're saying, hang on a second, we didn't get the double bottom. The bulls attempted to create a double bottom, it failed. So I've got to find ways to get into this trade. There's a nice breakout, there's a follow through, nothing for me to trade. I just need a pullback, and I see that that's a pullback. Why is it a pullback? Because we broke above the high of the previous candle. So the market broke above it, pulled back, but the bears were strong enough to resume the trade, and it got a decent enough signal. That's a trade to get in there, because of that breakout, we can put your stop just above the high of yesterday. Okay, and if you do that and you're not waiting to take your trade, you're just down here, half a percent, not half a percent, half your risk. If you're risking 1%, 0.5%. But we don't put the stop above here, guys. Nor do we put the stop above here. That's not the correct technical place to put the stop in. So there's a measured move. If you're taking profits, that's where you take profits. That's why you see that tail forming, that's profit taking happening right here. But then the price action carries on. You got to make a decision because you don't know all of this stuff. Okay, you've put your measured move here and you kind of thinking, well, okay, if the market is seeing all of this as a first leg, we might go that far, but you don't know that at this particular stage. Remember, we kind of spoke about, did I remove the major trend reversal? So we don't know yet all the stuff that's happened to our right. Okay, we don't know that stuff yet. All we know is hang on with a strong acceleration here, break of a trend line, second break of a trend line. So all of this could be a major trend reversal. The bulls could be attempting to reverse that as strong as it is. So that's where you got to make your decisions. So if you're not in a trade, okay, you're waiting to see if one, it's a major trend reversal that gives you an opportunity to jump into a trading range trade, which might break out. Secondly, if you're not in a trade and you see all of this price action and you're saying, hang on, strong bearish price action, I might get a measured move. You're trying to find ways to get into the bear trade, right? And that's what you're waiting for. So you got to wait for a double top, you got to wait for a lower high. And what we get instead for the bears is a double top. That's what we were speaking about while everything was a bit nicely squashed up together. There's a double top. Okay, could have put your entry beneath that. So let's do this and just. Okay, so the first thing that you'd have noticed, higher low, not higher low. Higher low is down here. Double top, this one is a higher double top. Why is it? It's a double top, but this high here, this micro double top is higher than this double top, than this lower high. So it is still a double top. But when you see that, you don't trade that. You wait to see if you get a lower high. Yeah, arguably, you could have tried to trade that. You could have put your entry there, and you could have put your stop above there. Okay. Always gets interesting when I start to do this on my MacBook. My fingers get a little bit. There you go. Okay, double top, lower high. You could have put your entry above that and your goal beneath that, and your goal is to get down here. Or you could have waited and said, okay, I want separation. I prefer separation in my markets. I think these are called butterfingers or something. I prefer separation. I prefer 3 to 6 candles beneath a setup. So there is a setup. Let's wait for it. Market comes back. There is a lower high. If I'm trying to go for that measured move, would not have been triggered at this particular stage. If I'd been triggered, my stop is here. Then I just gotta wait to see what, because I'm trading in a bear market, but not triggered. Still off the double top. I'm trying to find ways to get into the market. 3 candles, that's a lower high. Okay, I'm just going to plonk it in so we can see it. Lower high off the double top, but I'm above the moving average. I want to see if I can get some acceleration. Oh, that's easier, George. Keep it pressed and move it. So I want to see, you can see, what's a telltale sign of a price action trader? They talk to themselves. That's because, you got to talk to the market. It doesn't talk back to you. It just gives you signals and candles and stuff. So fantastic lower high, but I'm not trading that. I want to see just some bear follow through after 3 candles. I don't get that. Get a doji. Trading range forming right here, failed breakout above it. So when I see a close with the moving average. So all I'm seeing now is price is trading range forming, but that's good, okay? Because that is still my key determining factor, okay? That lower high double top. I haven't had a breakout above that at all. So As long as I don't have a breakout above that, my thesis is not going to change. Okay, let me put it in for you. So there. Okay, that lower high. As long as I don't get a breakout above that, the pullback, I'm still thinking bearish. These are all attempts to break out by the bulls. Fail. Attempt to break out, fail. You know, all of these attempt to break out, fail. The bears are still showing strength because of the lower high. They close beneath the moving averages, which, you know, we're going sideways, so they're pretty flat. Again, attempt to break out, fails. Bears attempt, bulls attempt, fails to break out. Then I start to get a decent bear candle. Okay, now I'm saying, okay, this is getting quite interesting. Do I take a trade or don't I take a trade? I have a trading range that is formed quite well here, but my problem is my lower high, my double top lower high, you know, in that trading range, the market has tried to break above that. So if you take that trade, where do you put your stop? Measured move. Why measured move? Well, because if the market breaks out of this trading range, they want to try and get to that and they may fail. Okay, so if you're going to put an order beneath here or an order beneath here, if you take none of that trades, your stop is up there. Okay, so you can put an order there and see what happens. You're closing beneath the moving average, you've had a close beneath the moving average. If you don't take that, you're going to have to wait. Okay, so let's assume you take that stop up there. Now your goal, you are trading towards, remember we had that this measured move here, which will take you all the way down there. That's what you're trading towards. Or alternatively, you have a low, you have a high, and you're saying, okay, I know that's super profits way down there. I'm just going to look for my optimal profits, earliest profits. I can't find a way to get in there, but I can see that's the price move that I would have liked to trade, but there's no way to get in. Then I get a pullback, and my goal is still to get to here. Okay, high, low. Now I have that move, and I have that reversal here bouncing off the 10 EMA. I can take that trade because my goal is still to get here. But if I take that trade, stop is going to be here. But when we took the early trade here, we did a measured move of the trading range to see where to put the stop. Stop always has to be in the right place. Okay, if we didn't take that and the market breaks beneath that, pulls back, and then you see an entry, now you can put your stop here. That's where you can put your stop. And because you put your stop here, you're waiting to see what happens if the market gets here. So you get triggered in and you get all of this price action. You do not close your trade. That's why we have a stop in the market. Okay, and it's not as sweet as it would have been here to take a trade and take some profits down here, but you let it be. That's what you got to do. Keep it up there and just wait. All of this price action, wait. When the market starts to break beneath this trading range, you can pull back. Then that stop that's there can now be pulled down to the top of this trading range, which will be just above your break even. But you're waiting to see the market get down. There's no need to get out of the market. There's no reversal here that's worthy of you to get out of the market. So you would have just carried on waiting for pullbacks to the moving average, okay? And wait for something clear. There's a clear trade you could have taken. We then have another breakout. You wait again, same structure that we had here. You wait, put your order beneath here or your order beneath here and take a trade, okay? Until you start to get this price action. This price action, yeah, this is important to just say this as we close. This is like a news breakout. And this is why you got to try and stay out of, if you trade in the S&P 500 or any red news breakout. Remember I said one news announcement, I want to be out of the market 30 minutes before. If there's double news, an hour. If there's, like an FOMC and there's like 4, just not in the market for several hours, just stay out of the market. That's what's causing this, but the trend resumes again. So you remember to jump in. Guys, thank you very much. I hope the S&P gave us some insights into our trading strategies, and we'll catch up again next week. Appreciate your time. Thank you very much. Guys in the office, thank you very much. Appreciate it.